From New York City for our viewers worldwide, I'm Matt Miller, back at Bloomberg headquarters. The countdown to the open starts right now. Coming up to kick off the week, investors bracing for a critical stretch of economic data. President Biden preparing to quadruple tariffs on China EVs, and meme stock mania continues with GameStop surging ahead of the open. We begin, though, with the big issue, and that is the countdown to CPI.
There is a good chance that we're going to see a number that ends up being neither fish nor fowl. If we get the 0.3% on core CPI, that is excluding food and energy, that will be a little cooler than we saw in the first quarter. The problem is, for me, and when it comes to thinking about the Fed, is they haven't really laid out their methodology for beginning to lower rates.
Joining us now to discuss is HSBC's Daragh Maher and Invesco's Matt Brill. Welcome, gentlemen. Thanks so much for joining us on this Monday morning. Very interesting as we wait for CPI to maybe show inflation cooling off a little bit. I think the core reading last month was 3.8%. We're looking for 3.6%. But it's not enough, is it, Daragh, to allow the Fed to start thinking about easing?
They can't pivot again. We've had three upside surprises. That 2 months they ignored. The third month we got the change in rhetoric to say, we're going to be slower to get that confidence that we are in a position to cut rates. I think even if we get a low ball number this week, it's going to be hard for them to flip back to saying, oh look, we're back. The case is back there for kind of a swift easing. The fact that we heard from Governor Bowman talking about he doesn't think there's going to be a cut at all this year. There's quite a degree of skepticism, I think, on the FOMC. Look, ultimately, I think we get a cut. We're looking for a cut in the second half of this year, but just one. I just don't see the CPI number being enough to change the Fed's perspective. The market changes on a dime. We've seen that like many times this year already. But for the Fed guidance, I think they'll stick with the idea that we've got to be patient.
Yeah, it's not enough to slow down, equities. We had a bang-up morning session on Friday, up to 52 and I think 52.30 something on the S&P 500. And Matt, it hasn't worried issuance at all either, right? We have, I think, the 7th biggest week on record.
Yeah, good morning, Matt. We had an extremely busy week last week in the investment grade market. You had about 45 companies issuing debt, totaling roughly $60 billion. So, I think the companies that are out there, they're saying the market's open. Yes, yields are a lot higher than they used to be, but they're still worried about that you could get another large CPI print this week. Don't forget, we've got the undercard of the PPI print tomorrow as well. So, I think companies wanted to get the money in, get it done with, just in case if you see a print like you saw last month where we saw rates up basically about 15 basis points across the curve when we missed so badly on CPI last month. So hopefully we're not going to get that this month, but I think companies just want to make sure that that was not on the table.
Matt, what are companies doing as far as maturities? Because I feel like a CFO who thinks we're going to get rate cuts isn't going to issue, any long debt. Are you seeing everybody come out with short issues?
So all the end of last year and the start of this year, all we saw was 3- and 5-year debt maturities being issued. And so it was basically companies saying, we think the Fed is going to cut. We think rates are eventually going to go lower. And we don't want to borrow for 30 years because I always have to point out to people that corporate bonds cannot be prepaid, unlike your mortgage. So they didn't want to issue longer debt. And so we saw very little percentage of that. But over the last, I'd say, month or so, you're starting to see that tick up significantly higher. So you went from around 7% issuance of long dated maturities to now closer to 17% of longer dated maturity. So I think what it's telling you is that companies are saying we might be in this for longer. Yes, we really don't like paying 5.5%, 6% for 30-year debt. But let's just go ahead and do it because, this is kind of the new reality that we might be in going forward. And, we're hopeful that that's not the case. But I think if you're a corporation, you kind of have to read the tea leaves that this is no longer going to be the quick fix that you thought it might have been.
I want to get, Daragh, before I get over to Mike McKee, to talk about the actual data points that we're waiting for this week. you focus on FX. How does the dollar look? I mean, if we thought we were going to get rate cuts, I would expect weakness, but it doesn't feel that weak, although we hit a peak earlier this year that's a bit higher. Is the dollar going to strengthen up if we get expectations for a hike?
Look, I think the dollar is like a long-distance runner at the moment. It's hit the wall a while back. We've had a big repricing already of Fed cut expectations. As you mentioned at the top of the show, equity markets are doing better again, not great for a safe haven like the dollar. So a few of the elements that had been helping the dollar are looking less supportive. But ultimately, we come back to the yield story. And if yields remain elevated, whether that's given another boost by the data or not, we will see. But if they remain elevated, and they are generally relative to the rest of G10, that continues to support the dollar. Now, whether it propels the dollar higher is a slightly different, question. We characterize the dollar as likely to remain strong, and that is a slightly different characterization from saying, look, we think the dollar is going to continue to strengthen. So that's how we're viewing it. We're looking, just to put some numbers on it, we're looking for 105 in euro dollar into year end. So not the stuff of legends, but it just shows that we think the dollar will at least hold on to the gains it's posted.
All right, let's get over now to our chief economics correspondent. Mike McKee is here with me at 7:31. And Mike, there's a lot of data coming out this week that really matters.
Well, really on Tuesday and Wednesday, Matt. Otherwise, Thursday, Friday, maybe people scoot early for the Hamptons or something because it is inflation week. And tomorrow we get, as Matt said, the undercard of the PPI, which will be important in itself because it'll give us an idea of direction. And the two inflation releases this week are basically going to tell the same story, a slight turn back towards downward momentum in the core. PPI is going to be a little bit higher. Energy's been up. Chair Powell tomorrow is also a major event, but it isn't the kind of event that's going to move markets as it has in the past. He isn't going to really change his view because he hasn't seen CPI yet. That does come on Wednesday. We get CPI and same story where the headline goes up a little bit on a year-over-year basis and the core goes down a little bit on the year-over-year basis. If that happens, then people are going to be happy because it shows maybe we're changing direction and heading in the right direction for a change. If we get a higher than expected CPI print, though, look out for what might happen in the bond market. Retail sales also out. We're expected to be slow, but there are some analysts on Wall Street who think they will be better than forecast. Then we get a lot of Fed speak throughout the week, of course, besides Jay Powell. Now, does it really matter what any of them say? Because they're going to be in the same position as Powell of not being able to really change their views unless they are speaking after CPI. And Powell is the one who matters. But here's an interesting thing. Just a few minutes ago, Philip Jefferson, who is speaking this week and also is the vice chair of the Fed, said this about all the Fed speak. It's a good thing to tell markets what you're going to do, but the potential for misinterpretation is especially acute when many policymakers speak at the same time and disagree with each other. So throw that into the mix, and it's going to be an interesting week, especially on trading desks.
Yeah, I mean, a couple of big data points in the economy, but we've had a strong earnings season thus far, and we still get some big numbers out. I think Home Depot is tomorrow, Deere is on Wednesday, Walmart is on Thursday, and, of course, for Bloomberg Television, we have a lot of key guests, right? Janet Yellen coming up. Mike, what do you expect Yellen to say?
Well, I think she's going to try to stay out of the political fray. She's been criticized for that, but how could you not find out what she thinks about the dollar if she'll tell us? That is going to be really important. And, of course, the tariffs that the president's about to put on are a very big story as well. So a lot going on and a very worthwhile interview. Of course, the big event of the week has already happened, and that is your return to work here.
Thank you very much. I'm glad to be back. There's no one crying at the office, so it's a lot easier to deal with than being home with a couple of babies. Mike McKee, our chief economics correspondent, thanks very much for that. Let's get back to Daragh Maher and Matt Brill. Matt, I mentioned earnings, and Bloomberg News reporter Jessica Menton wrote a fantastic story about earnings expectations really being driven up because of the positive results we've seen so far. 90% of S&P 500 companies have already reported. What does this mean for the companies that you cover? What does this mean for credit? You already told us issuance was good. Are they able to keep spreads low?
Yeah, absolutely. There hasn't been a lot of crying in the IG market recently either here. So you've seen good fundamentals. You've seen, the earnings coming in, and with earnings coming in and really solidifying the idea that companies are not going anywhere from a pure fundamental standpoint, going anywhere worse from a pure fundamental standpoint. With all-in yields where they are, we're seeing just massive inflows, 25 straight weeks of inflows into the investment grade market, which is driving spreads lower. So until you see any kind of cracks in the fundamental foundation of IG and as well as high yield, you're going to continue to see spreads grind tighter because it's all about yield. It's all about yield. And as yields stay high and there's no defaults or minimal defaults, minimal downgrades, it's an extremely attractive yield market. It's not a very attractive market from a spread standpoint. So we are at our lows on the spreads in both investment grade as well as high yield.
Well, because the economy seems to be doing fine. Daragh, how do you see this, globally? I think you just put out your monthly currency outlook. How does the rest of the world look compared to a U.S. that's running on all cylinders? Yes, we had some soft employment data, but otherwise, things are looking up in terms of, GDP estimates are coming up the same way earnings estimates are.
Yeah, very much. Look, the U.S. story has been one of people being upbeat and then being forced to raise their estimates, whether it's raising GDP, lowering unemployment forecasts, and of course, alongside that, they've also been raising their inflation forecasts. I do think the data points you cite recently, just some softness creeping in. This is a new thing for the U.S., to get downside disappointments and activity. We've not generally had that over the last couple of years. And at the same time, in Europe and elsewhere, we're beginning to get a few upside surprises. Again, a rarity on the activity front. Now, look, the gap is still enormous in terms of relative performance, but it just bear watching. And, talking about those headwinds, the dollar, that relative growth story, in terms of levels, it still favors the U.S., but maybe just in terms of the delta on the data, it's just beginning to be a bit more of a headwind to the dollar at this point.
How does the dollar, Matt, affect issuance in terms of global issuance? I mean, the strong dollar have any effect on the currency people are going out for?
So, what we've seen globally in terms of, generally just hedging costs have been prohibitively expensive. So, that's really more of what most of our investors actually hedge the currency. They don't take it on straight. And you've seen particularly the Japanese investors, it's been extremely expensive for them to buy U.S. investment grade, hedge it back into yen. But the idea is that eventually, as the Fed starts to cut and the Bank of Japan actually increases rates, those hedging costs are going to come down. So there's been that thought that hedging costs will come down. They can lock in yields now and then hedge the cost, have the hedging costs go down later, which would be very good for them. So we've been seeing significant inflows on that notion. If the CPI is not where we need it to be, if you see inflation continue to stay too strong here in the U.S., that will not be good for inflation or for hedging costs down the road, which would then be a negative from overall flows into the investment grade market.
Daragh, you look at, you're focused on FX, but you look at research across asset classes as we head for another positive open here in the U.S. How does the U.S. equity market look to you?
Look, the backdrop is still constructive. Earnings are still doing well. The economy is still doing well. So it's hard to be too bearish on it. I know our team have generally looked for around 5% upside thereabouts on the S&P 500. What I think has been curious, just speaking again, putting on my currency hat, is the relationship between the dollar and equity markets, risk appetite, if you like. Historically, it was very straightforward, inverse. This year, it's been a much more fickle relationship. And so, I'd love to be able to take my cue from equities in terms of driving a currency view, but maybe a bit like your home setup. Yeah, I'm driven to tears trying to work out that relationship at the moment.
Thanks very much for joining us, Daragh Maher and Matt Brill, on this Monday morning. Joining us now with a look at stocks is the aforementioned Jessica Menton, in for Abigail Doolittle. Jess?
Matt, I have to say it's great to have you back in the office. And of course, the S&P 500 is coming off its third weekly gain, and options markets are pricing in a 1% move in either direction on Wednesday post that CPI report. So we have had nearly 90% of the S&P 500 already reporting earnings, but we still have big names this week, like you mentioned, Matt, with Walmart, Home Depot, Cisco, Alibaba, and Take-Two. For this morning's big movers, though, have to start with Apple, ticker symbol AAPL, that stocks up more than 1% after Bloomberg's own Mark Gurman and Julia Love both reported that the company is closing in on an agreement to use OpenAI's technology on the iPhone. Another stock I'm keeping a close eye on is Intel. That stock's also up more than 1%. It's actually gaining after the Wall Street Journal did report that the chipmaker is in advanced talks for a deal in which Apollo Global Management that would provide more than $11 billion to help the company build a plant in Ireland. And you know what, Matt? Guess who else is back? Roaring Kitty. If you look at GameStop shares, GME is the ticker symbol on that. If you look heading into the opening bell here, up 44%. So it's poised to have the kind of last surge last seen during, as you remember, Matt, that meme stock mania in the height of 2021. If you look at already going into this month, that stock was up about 57%. So if you look at today's gain and going into that close, it would actually be on pace to potentially beat its monthly gain back in March of 2021, Matt.
Did you see his tweet? Roaring Kitty is,
Yes.
of course, Keith Gill. He's the main figure in the movie The Big Short, I think it's fair to say. And he'd been off social media for a long time, but he had a tweet that was like a guy leaning forward playing a video game.
That's right. It's showing he's still paying attention to what's happening right now. And I have to say, if you look at AMC, that stock's also up in pre-market trading heading into that. That stock's up about 17%. So not just GME, but other meme stocks as well, Matt.
Little meme stock mania. We could hear from Bailey Lipschutz.
That's right.
Today,
I think we will.
Covers those. Jess, thanks very much. Jessica Menton there talking to us about stocks ahead of the open. Coming up, President Biden is set to unveil new tariffs on Chinese EVs.
The bottom line is I want fair competition with China, not conflict. And we're in a stronger position to win the economic competition of the 21st century against China or anyone else.
The White House preparing to quadruple tariffs on some of China's goods. The details next. This is Bloomberg.
They're not competing. They're cheating. They're cheating. And we've seen the damage here in America. The bottom line is I want fair competition with China, not conflict. And we're in a stronger position to win the economic competition of the 21st century against China or anyone else because we're investing in America and American workers again.
President Biden set to quadruple tariffs on Chinese EVs later this week. The White House framing the measures as a defense of American workers. The total tariff on Chinese EVs will rise to over 100% from an already whopping 27.5%. It'll double or triple in other targeted measures. Bloomberg's Craig Trudell joins us now for more. He has covered the auto industry in Detroit, Tokyo, and London, so all around the world. Craig, this is, I think, a fascinating story because at least one car that I've seen out of China, the BYD Seagull, looks really well put together and could be had for as little as $10,000. I think a lot of American families would be happy to get a deal like that.
Yeah, we absolutely could use some cheap Chinese EVs, and yet I think there is real concern in Detroit about them coming into the U.S., and particularly among the American car worker. And I think that's a big part of what's going on here. We heard Biden, say coming off of the break that this is a matter of cheating versus competing. It's fascinating that we're seeing much of the rest of the world try to some degree replicate China's attempt to subsidize its way to a more competitive car industry. I think the issue is that China got off to such a head start over the rest of the world that in order to play catch up, the sort of terms of competition are going to have to change, and it is already the case that, to your point, 27.5% is absolutely whopping. Car companies don't operate with those sorts of margins, so this is largely symbolic. This is a case where the U.S. was already close to these companies to the extent that there was even just a sliver of opening. Biden wants to shut that completely.
Yeah, the thing is, I had previously thought of these Chinese products. I mean, leave aside the political, are they cheating or are we being protectionist? I previously thought they were just cheap, shoddy, poorly put together products, but I've been watching a couple of teardowns of BYD vehicles, and they look really well put together. Great quality control, efficient design. I mean, they could compete if we were on a level playing field.
Yeah, I think that was a takeaway that we saw out of the Beijing show just in the last couple of weeks, where you had, some Western journalists able to go to that car show. I think, a combination of the fact that, that COVID led, car shows to go virtual for a while. And then, for some time, it was interesting that, it was really difficult to get into China to cover car shows. I felt like there were a lot more Western journalists at Beijing just in the last couple of weeks. And the impressions were really stark, where you had, outlets that really had, nothing but praise to shower on some of these companies. And it's both, being able to actually, make cars that, don't feel flimsy, that do have, a real sort of quality look and feel and material to them, but also the tech offerings. And I think, when you talk about the batteries, not only the cost, but the ability to offer range that is extremely competitive or would be really competitive in the U.S. And also, the fact that the Apples or Google equivalents in China are actually getting into the car business. I think it absolutely is as fascinating a market as it's ever been. And, the inability to sort of, take that and try it out elsewhere in the world is really, for some consumers going to be viewed as a shame.
Well, we're lucky to have you leading our coverage of cars for around the world. Craig, thanks so much for joining us. Bloomberg, Craig Trudell there in London. Stay tuned for more on this, because we are going to be talking to Treasury Secretary, U.S. Treasury Secretary Janet Yellen. That's an interview you don't want to miss at 10:15 Eastern this morning. It's 3:15 p.m. London time. Coming up, the morning calls. We're going to tell you which stocks analysts like or dislike. And then later, Kayla Bruun of Morning Consult joins us around the opening bell, weighing in on the U.S. consumer as retail earnings start to ramp up this week. This is Bloomberg. Time now for the morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Bank of America downgrading Penn Entertainment to a neutral, pointing to muted Q1 results and a limited market share gain for ESPN Bet. Next up, HSBC naming Delta as its top pick with the U.S. airlines, within the U.S. airlines, highlighting its strong competitive position and increasing demand for international travel. Finally, Cisco losing its only negative rating on Wall Street. So that's when BNP upgrading those shares to a neutral. This is Bloomberg. This is the countdown to the open. I'm Matt Miller. Moments away from the start of trading, we're looking at gains on the S&P 500, NASDAQ, and Russell 2000 futures up almost 1%. Take a look at what's going on in some of the other asset classes that we follow this morning. Of course, you're going to see some currencies there. The euro up against the dollar right now. The 10-year yield down at 446.49, and NYMEX crude up a little more than 0.5% at 78.74. a barrel. But back to the single stock stories that we care about. Alphabet and Apple doing well this morning. Shares of Alphabet are, moving this morning, I should say. Shares of Alphabet are declining as Apple is said to be closing in on an agreement to use OpenAI's technology on its iPhone. Of course, Google is a big challenger to that, or a competitor to OpenAI. Jess Menton is here with more on this battle. Jess?
Well, looking at Apple's stock, up more than 1% right at the opening bell here. And this is a stock that investors have been watching very closely just because it had one of its worst performances relative to the S&P 500 last quarter since the height of the dot-com bubble bust. So looking at this, Apple's actually nearing this deal to use OpenAI on tech on its iPhone. So, of course, Bloomberg's own Mark Gurman, as well as Julia Love, did report this story exclusively for Bloomberg on the terminal. So the company is closing in on this agreement to use OpenAI's technology on the iPhone. If you look over also for stocks like Apple, moving marginally higher as well just after the opening bell. So the two sides, when you are looking at Apple as well as OpenAI, have been finalizing terms for a pact to use ChatGPT features in Apple's upcoming iOS 18 mobile mobile operating system. So you are seeing that stock boosted there. It's still off a little bit more than 7% from that all-time high in December, but nonetheless, it's paring a lot of those losses after it entered a basically a correction back in March, and so now it's back below that 10% drawdown that we did see from that all-time high in December, Matt.
All right, Jess, thanks very much for that. Let's get to another deal. Big headline across the terminal this morning. Intel is in advanced talks with Apollo for a deal that would provide more than $11 billion to help build a plant in Ireland. That, according to the Wall Street Journal. Ed Ludlow has more on that from the West Coast. Ed?
Good morning, Matt. Matt, welcome back.
Thank you, sir.
Intel up a percentage point. It's a big headline, but a relatively muted move. The Wall Street Journal is reporting that Apollo and Intel are in advanced exclusive talks for about $11 billion in financing. And this is for a fab, right, for the foundry business, a build out in Ireland. And it's an extension of kind of what Bloomberg's already reporting, right? Intel has previously done deals with alternative asset managers. It's part of Pat Gelsinger's smart capital strategy, where, as we know, he's like talking with the public sector, looking at government grants and loans, which he's been successful in securing both in Europe and the United States through the CHIPS Act. Then there's the strategic technology partners, and then there's kind of the alternative financing. Bloomberg had reported that Intel had spoken with a number of firms just like this. $11 billion is kind of the middle scale of Intel's ambition. They have an arrangement to invest more than $30 billion US in Germany. They are making investments in Israel, and we know about the domestic onshoring of their fab capacity here in the United States. It's the other part of their business that they're trying to build out. Foundry, be a third-party contract manufacturer, and the stock now higher 1.4% for other chip names. The problem is that revenue is going in the wrong direction at that unit, and its losses are widening. So a positive headline, the stock higher, and it's one where we await confirmation in the coming weeks.
They've got to do something, right, Ed? I mean, when I was a kid, and I'm pretty old, Intel was, you couldn't be beat. But they seem to have really missed out on the whole AI thing and haven't been able to catch back up, even after a couple of years' warning.
Gosh, I think that's a pretty accurate summary. Technology leadership on the manufacturing side is them fighting to catch up with TSMC, to be at the cutting edge of nodes for manufacturing. And the AI story, you're right. Intel is still the world's biggest maker of PC chips, processors. But the most lucrative market is high-performance GPUs or combination GPU, CPU, AI accelerators that go into data centers or server stacks in data centers. And that's a market they have fallen behind in. If you look at their equivalent product to NVIDIA, Gaudi 3, they'll probably do $500 million of that AI accelerator this year. NVIDIA is going to do what, 40 billion? AMD will do $4.5 billion. So Intel's way off the pace for that lucrative AI accelerator market.
Ed, thanks very much. Ed Ludlow there from Bloomberg Technology. For those watching at home, a PC is like a laptop or a tablet, but it's bigger and clunkier, and you would put it on your desk if you bought one. But you don't. More M&A this Monday. Squarespace has entered into a definitive agreement to go private by Permira in an all-cash transaction valued at approximately $6.9 billion. Isabel Lee is here in the studio with more. Isabel?
Hey, Matt, investors seem to be liking this news. There's a lot of optimism because shares are rising around 13%, which is the most in 14 months. Volume is also surging. So Squarespace is a web design platform that went public in May 2021, and it was valued at that time at around $6.5 billion. And for now, investors are liking this deal because with this deal, investors are going to get $44 per share in cash, representing a 15% premium compared to Friday's close. And this deal is expected to close at around the fourth quarter of this year. And the special committee unanimously approved this and recommended this. So the founder and CEO, Anthony Casalena, is rolling over a substantial majority of his existing equity and will continue to lead as CEO. So this is seen as a huge boost of confidence. He was the founder and founded this company over 20 years ago, and he is still going to be the leader moving forward. So long-term investors like General Atlantic and Axel are also expected to reinvest as part of the agreement. And of course, we have the May 15 Investor Day scheduled, now not in plan. But on May 7, the company reported earnings since Squarespace boosted its revenue for the full year. So that also beat estimates. And for now, shares are still up around 13%.
All right, Isabel, thanks very much. Isabel Lee on Squarespace. Turning now to meme stocks. GameStop is surging once again, this time after a cryptic tweet from Keith Gill, known as Roaring Kitty. Katie Greifeld is here with more on the biggest move we've seen in GameStop since, what, 2021?
That's about right. March 2021, the last time we saw GameStop really rally to this degree. So like you said, Roaring Kitty, his real name is Keith Gill. He played a starring role in the 2021 meme stock mania. He really helped to rally day traders behind the cause of squeezing GameStop short sellers. Remember, GameStop shares, they soared by about 1,600% in January 2021. They're lower by about 80% since that peak. But in any case, Roaring Kitty, he hasn't posted on social media since June 2021. And what everyone is excited about is that yesterday he posted a meme that shows a cartoon man leaning forward with what appears to be a game controller in his hands. As you can hear, I'm doing deep fundamental analysis here, but traders, they seem to be interpreting that as Roaring Kitty is back, whatever that may mean. But that's why GameStop shares are currently higher by about 54%. Like you said, that would be the biggest gain since March 2021. You have the options market lighting up as well. And you take a look at AMC, for example, another meme stock favorite. Shares currently up about 22%, Matt.
GameStop shares are limit up?
There you go.
Limit up?
Limit up.
Triggering a circuit breaker, shares are up 54%, but they currently can't move any higher because of stock market rules. I think we look at a pause and then they'll start trading again. All right, with CPI out tomorrow and retailers like Home Depot and Walmart out with earnings this week, the market's going to get a good look at the state of the U.S. consumer. Joining us now with more on that subject is Kayla Bruun. She is a senior economist over at Morning Consult. And Kayla, we've already had 90% of S&P 500 earnings out for Q1, and they have done so well that analysts are ratcheting up earnings expectations for Q2 and the rest of the year. So what do you expect from these giant retailers, Home Depot and Walmart?
Well, overall, I think some of the optimism around earnings for some of these companies is really tied to what I would describe as a surprisingly resilient consumer overall in the U.S. We've seen spending hold up. Retail sales went up a little more than expected this month. And in our own data at Morning Consult, we also see stronger spending year over year. I would caution, though, that when we cut our spending data by demographic cuts, we're seeing the gains are not necessarily evenly distributed. And it does seem to be a little bit more the higher income adults that are supporting these top line spending numbers. And it's lower and middle income adults who are maybe being a little more cautious and frugal with their spending. That being said, a retailer like Walmart might still benefit from that. We've seen that before with the inflation surge when we saw a lot of trading down going on with consumers really seeking out that value that actually benefited certain consumers like Walmart. So it could be a bit of a mixed bag for that reason.
How does the U.S. consumer look, Kayla, if you take out, say, the top quintile? If you look at the average American, it seems like credit card debt is strong. Mortgage rates are too high to buy or sell a house because you need to get back in someplace else. Rents are high right now. How does the U.S. consumer look other than, the qualified investor?
Yeah, and those headwinds, I think, are a lot of why we're seeing a little bit of a divergence between higher income adults who also are benefiting from, say, the S&P being up a lot this year so far, whereas middle and lower, sort of that median adult isn't benefiting as much. That being said, the labor market is still pretty strong. Unemployment is so low. So I think that's helping to support, and prevent any sort of collapse for even that kind of average everyday consumer. One measure that we have of this that kind of does give me some, sort of a good reading on the average everyday consumer in Q2. We are coming out this week with, we have this report where we ask the Feds a similar question that the Fed asks on an annual basis about how a consumer would handle an emergency $400 expense. And we actually saw for Q2 that it was the highest level yet would be able to just pay for it with cash since we've been tracking. So that is kind of a positive sign of sort of, it's a little bit of like a pressure test for the consumer budget. How would they be able to handle this expense? And it looks like they're in pretty good shape relative to when we've been tracking over the past year and a half or so.
Maybe they would try and use a buy now, pay later scheme. You know, we had a great story on how it's difficult to measure consumer debt because a lot of consumers are using these kind of schemes to get a product they couldn't otherwise afford. They've already racked up the maximum credit debt or taken as many loans as they can. What do you think about buy now, pay later?
We've definitely been tracking that, and we saw a big surge in usage, and not even just for the groups you'd expect, but high-income adults were really leaned into it over the holidays. We also saw parents have been a pretty big user of that, trying to redistribute costs. Parenthood is expensive. So that is one of those sort of shadow areas where we are seeing some signs of, I don't know if you'd call it strain necessarily, but just a sort of a diversity, a different way that consumers are sort of paying for things, and another kind of reading that isn't necessarily going to be captured by those traditional measures. And that has contributed to some uptick that we definitely saw starting in maybe mid-2023 in our data. When we look at sort of the monthly financial obligations ratio for consumers, that increase in buy now, pay later debt, that's still dwarfed by things like credit card debt, but the trend is very sharply upward.
By the way, first of all, I just had my second child, and that kind of triples the cost, so I understand that. I'm locked in my house because I got a great rate before they rose. Is the housing picture kind of a double-edged sword? On the one hand, it's stuck, right? There's no movement. On the other hand, many Americans refinanced at low rates, and so their biggest debt expense isn't that high.
It definitely is a bit of a double-edged sword, and it's the timing of when you did or didn't buy a home is currently playing out as a major differentiator in consumers' finances, because, as you said, there's really not a lot of movement. Home sales are definitely suppressed by these higher mortgage rates. At the same time, though, as difficult as it is to buy a home, there has, at least for those who are renters, there's been a large influx in particularly multifamily supply over the past few years. That's where we've largely seen some cooling in the housing market, is with those rent prices. Not so much necessarily because of interest rates, but because of that growing supply. That being said, if we're, tying this back to inflation and what we might expect for the shelter component of inflation, we're still seeing a lot of stickiness there. There has not been quite as much cooling as many may have hoped. So the housing market is a big thing to watch for many reasons, both for consumer finances and for the Fed's decision making and how it ties to inflation.
Absolutely. Kayla, thanks so much for joining us. Kayla Bruun there, a senior economist at Morning Consult, talking to us about what to expect from retailers, inflation, and housing. Coming up, Archegos founder Bill Wang is in the hot seat.
We're very disappointed at the situation. We're taking it very seriously. We're reviewing the different prime brokers relationships as well as the GFO, the family office relationships, reviewing the risk management processes.
That conversation still ahead on his day in court. This is Bloomberg.
We're very disappointed at the situation. We're taking it very seriously. We're reviewing the different prime brokers relationships as well as the GFO, the family office relationships, reviewing the risk management processes as well in order to get the lessons learned out and make sure it doesn't happen again.
Opening statements in Bill Wang's criminal trial kicking off in New York this morning. The Archegos founder facing charges of fraud and racketeering conspiracy that could end with a lifelong sentence in prison. Bloomberg's Shonali Basak joins us now outside the federal district courthouse. So, Shonali, what's going to happen and when are we going to see it start?
We should see it start shortly here, Matt. You do have a very busy agenda here in white-collar crime at the Southern District. Of course, we saw FTX, really the trial be pursued just really months ago over here as well. We expect opening arguments, but we also could see a witness called to the stand as early as today. It's likely that the first witness could be somebody who is a counterparty over at UBS. Of course, what we know the prosecution is trying to bring forth is a sense of what Bill Hwang and his deputies had told those banks. Part of the initial indictment was this idea that they misled the banks into trading with them, as well as extending a lot of credit in the way that they extended the swaps agreements as well to amass massive positions, ultimately growing that securities portfolio to $160 billion before failing and ultimately causing billions worth of harm to major banks. So we will hear from counterparties. Of course, we know a lot about the jury as well, Matt. This idea that some of them do have some experience in finance, but many, of course, do not. That was a very intentional part of this, making sure that the jury that had been selected did not have personal contacts, for example, who had exposure to some of the stocks that Bill Hwang and his family office had traded and, of course, lost money in regard to. And so, of course, this will be a multi-week trial. And, of course, we know that Bill Hwang defends himself or intends to defend himself vigorously, and that a lot of what he traded did not require disclosure to begin with. So it'll certainly be an interesting trial, multi-week trial, but today we just get started.
We heard a couple of times this hour from previous interviews with Ralph Hamers. You are, of course, our chief Wall Street correspondent, Sonali. How many banks did this blow up touch? Remind us, what kind of devastation Wall Street saw because of Bill Hwang and Archegos, and how much have they really clamped down on controls to make sure something like that doesn't happen again?
Fairly meaningfully, and not just the banks, remember regulators as well. But I've got to say, Matt, one thing to me that's the most interesting about what happened after Archegos is you had the SEC and the CFTC in particular really look at disclosures around swaps, because remember, that's how these positions were amassed. They also, the regulators, tried to initially say that this would require family offices to have more disclosure around their holdings, and that part never really happened. We never really saw that type of disclosure. One major question that is kind of burning in the minds of investors is, remember how many hedge funds have converted into family offices in recent years? Well, they still require more disclosure. Will this trial really bring that debate back to surface? Especially because we know, to your point here, Credit Suisse, Morgan Stanley, Nomura, Credit Suisse lost billions of dollars off of this. Morgan Stanley, hundreds of millions of dollars. These were real losses at the end of the day, and some of the rules have not changed.
All right, Sonali, thanks very much. Sonali Basak there, chief Wall Street correspondent outside the federal courthouse in Lower Manhattan. Now let's get back to the stock market story. For some of the sector price action this morning, we go back to Bloomberg's Jess Menton. Jess?
Looking at the S&P 500, sitting just about 0.5% away from its record last reached at the end of March. If you look on a sector basis in the industry groups here, real estate and utilities are the ones that are driving things higher. Of course, utilities has been on a tear, up 14% in the past 19 sessions. If you look at the opposite end of that, communication services, the lone laggard here, down more than 1.5%. A lot of that is driven by the weights when it comes to Alphabet as well as Meta. Of course, don't forget the Dow. It's still marching toward 40,000. It's been 869 trading sessions through Friday since the Dow first crossed 30,000. So looking to see when that could potentially happen. Now looking at more of some industry groups here beyond just this, the Golden Dragon Index is showing an impressive rise this morning, up about 3% today and up over 9% this month alone. Alibaba is not surprisingly leading the advance here because they do report earnings tomorrow. The U.S. listed shares of Baba are up more than 4%. There's also some moves here. If you look at Tencent Music Entertainment, also a major contributor to this index. It did post fiscal first quarter revenue that beat consensus estimates. And then you do have JD.com's price targets being raised by Loop Capital, Matt.
Wow, 40,000. When I was an intern at Tucker Anthony, we had Dow 6,000 shirts made up. That was back in 1996. Jess, thanks very much for that. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg. Time Time now for the Trading Diary, what you need to be watching today. Treasury Secretary Janet Yellen will join Bloomberg Television at 10:15 a.m. You don't want to miss that interview. And then another blockbuster interview at 10:30. We hear from the CEO of Goldman Sachs, David Solomon. Home Depot earnings are out tomorrow, plus U.S. PPI figures. And finally on Wednesday, the all-important CPI and retail sales. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.